Hello students, in this video we are going to talk about different tools of monetary policy. What do we mean by monetary policy? Monetary policy refers to various measures adopted by central bank of the country in order to control the money supply in the economy. They can be quantitative or qualitative measures. Why monetary policy is needed? Monetary policy basically means an increase or decrease in the supply of money in the economy. It is done by regulating the creation of credit by commercial banks. Central banks needs to control the supply of money in order to cope up with different situations in the economy like inflation or deflation. Monetary policy can be expansionary, in which there is an increase in the money supply, which is usually undertaken to tackle deflation, or it can be contractionary, in which there is a decrease in the money supply, which is usually taken to tackle the situation of inflation. Now, let's focus on the quantitative tools of monetary policy that aim at controlling the overall supply of money in the economy. The first and foremost quantitative tool that we are going to study is bank rate. Bank rate is the rate of interest at which central bank lends money to commercial banks. Any change in the bank rate is often followed by the change in the lending rate of commercial banks. As it can be seen in the cartoon given here, the interest rate cut by RBI is followed by interest rate cut by commercial banks. Thus, when bank rate is increased, market rate of interest also increases. This lowers the demand for credit and therefore supply of money tends to fall. Alternatively, when bank rate is decreased, market rate of interest is also decreased and it increases the demand for credit and therefore increases the supply of money in the economy. Repo rate. Repo rate is also the rate of interest at which RBI gives loans to commercial banks. But the basic difference between bank rate and repo rate is that of time period. Repo rate is often for the short period loans that commercial banks takes from central bank by buying government securities in the open market. Again, change in repo rate is directly related to change in the market rate of interest. During inflation, the cost of capital is increased by increasing the repo rate. This lowers the demand for credit and therefore money supply in the economy also decreases. Whereas during deflation, the cost of capital is reduced by reducing the repo rate. This increases the demand for credit and as a result money supply in the economy also increases. Now, along with repo rate, the another quantitative measure is reverse repo rate. Now, this is the rate at which RBI accepts deposits from commercial banks. When reverse repo rate is decreased, banks are discouraged to park their surplus funds with RBI, and this leads to a rise in the credit supply by commercial banks. Whereas, if there is a rise in the reverse repo rate, then it may induce commercial banks to park more funds with RBI to get more interest income, and therefore supply of money is reduced in the economy in order to control inflation. Now, after discussing bank rate, repo rate and reverse repo rate, let's talk about two legal reserve ratios, that is CRR and SLR. CRR is the minimum percentage of banks' net time and demand deposits that are to be kept with RBI as reserves. Any change in CRR changes the credit creation ability of commercial banks. Let's see this example. If CRR is 4%, then if a commercial bank gets a deposit of rupees 100 crore, it will keep rupees 4 crore, which is 4%, with RBI as reserve, and rest 96 crore can be used for distributing loan. For example, CRR is raised to 8%. In this case, the same deposit of rupees 100 will be kept with bank as reserve for rupees 8 crores and rest 92 crores can be used as the balance for distributing loan. Thus, it can be seen as the cash reserve ratio increases, the credit creation capacity of commercial banks decreases as more amount is to be kept with central bank as reserves out of the total deposits received. So in the nutshell, when supply of money is to be increased, CRR is lowered, and when supply of money is to be reduced, CRR is increased. Coming to the next ratio, SLR. Again, it refers to the percentage of deposits of commercial bank that are to be kept with themselves as reserve in the form of liquid assets. Again, as it was there in the case of CRR, here also to decrease the supply of money during inflation, the central bank increases SLR. Conversely, SLR is reduced to increase the supply of money during deflation in the economy. As we know, any decrease in SLR will lead to more funds available with the banks for lending, and any increase in SLR will lead to less funds available with banks for lending, as a greater proportion is to be kept as reserves. Open market operations. Basically, it refers to sale and purchase of government securities in the open market by RBI on the behalf of government. So, when RBI sells securities in the open market, it soaks liquidity from the economy and thus reduces the money supply. Whereas, if RBI purchases securities from the market, then it releases liquidity in the market and hence increases the money supply. Thus, sale of securities reduces the money supply and purchase of securities by RBI increases the money supply in the economy. In nutshell, when there is inflation, it is corrected by selling securities and soaking liquidity, while deflation is corrected by buying the securities and releasing the liquidity. So these were the quantitative tools of monetary policy. Coming to the qualitative instruments that focus on selected sectors of the economy. The first one is margin requirement. It is the difference between the current value of the security and the amount of loan. For example, a person takes a loan worth rupees 80 lakh and mortgage his house which is worth rupees 1 crore. Then the difference between amount of security and loan taken is the margin requirement, which is 20 lakh in this case. Thus, margin requirement is increased when the supply of money needs to be reduced, as it discourages borrowers to take loan. Whereas the margin requirement is decreased when the supply of money is to be increased, as it encourages borrowers to take loan. Moral suasion, another qualitative tool. It is nothing but just the advice given to commercial banks by RBI in order to control money supply in the economy. Banks are advised to restrict loans during inflation and be liberal in lending during deflation. Last tool, rationing of credit. It refers to fixing credit quotas for different activities. Rationing is introduced when supply of credit is to be checked, particularly for speculative activities in the economy. So, this was all about monetary policy tools. We have studied different quantitative tools like bank rate, repo rate, reverse repo rate, cash reserve ratio, SLR and open market operations, whereas under qualitative instrument we have studied margin requirement, rationing and moral suasion. I hope all the tools are clear to you. Thank you and have a nice day.